Hi, this is Claus Vogt for Money and Markets TV. Over the years, we have learned a few things about inflation. First of all, it's man-made. It's caused by the policies that have been implemented more or less globally since the end of the Bretton Woods monetary system in 1971. But inflation has really exploded over the past decade or so as governments embarked on reckless campaigns of spending and money printing. We can see this inflationary pattern by looking at the US Consumer Price Index and foreign exchange reserves since 2000, when the global stock market bubble burst. At that time, foreign exchange reserves totaled $1.9 trillion. By the end of last year, they had jumped 378% to 9.3 trillion. I believe that the over-indebtedness of the US and other major countries will eventually result in very high inflation rates and possibly in hyperinflation. So I want to go over some historical findings about how inflation happens and how it affects the economy. In the book Monetary Regimes and Inflation by the Swiss professor Peter Bernholz, he says that the political system tends to favor an inflationary bias of currencies. All major inflations have been caused by princes or governments. In other words, politicians will print money if they are allowed to do so. After all, inflation benefits governments because it's nothing less than a tax hike in disguise. Second, Bernholz said that all hyperinflations in history have occurred during the 20th century, that is, in the presence of discretionary paper money regimes. In other words, if the currency is not backed by hard assets and is subject to the whims of central bank bureaucrats, inflation is the likely result. Third, monetary regimes binding the hands of rulers, politicians, and governments are a necessary condition for keeping inflation at bay. Unfortunately, in the US, Europe, and elsewhere, there isn't a strong enough public movement to stop the current reckless monetary and fiscal policy. Inflationists like Ben Bernanke are running amok with no opposition in sight. Fourth, hyperinflations are always caused by public budget deficits, which are largely financed by money creation. It's clear from this argument that the result of the budget deficits in the US, Japan, and most European countries will be inflation. But you might ask, why hasn't it happened yet? Well, it actually has. During the late 1990s, it came in the form of a global stock market bubble, and after that, as a real estate bubble. But another answer to the question is a bit more complicated. Bernholz says a continuous flow of new money into the economy leads to inflation only after a more or less extended time if the old money is also used abroad. Of course, the dollar and euro are used extensively abroad, which has held off hyperinflation for the moment at least. Finally, Bernholz gives us a warning for the future. A real budget deficit cannot be maintained permanently. The government must either reduce it or the inflating bad money will be substituted in time by the good money, and the base of the inflation tax will be eroded. So the United States and many European countries have to make a tough choice. Option number one is to cut spending drastically. This would plunge the world into an immediate and severe recession, and it would undo any benefits from the money pumping and deficit spending of the past few years. The second choice is to keep inflating and spending like there is no tomorrow. This will keep driving up prices, eventually leading to a funding crisis and a currency crisis. Based on the Federal Reserve's policy of quantitative easing and the European Union's bailouts of troubled member nations, I believe this course is the one they will pursue. The next steps in that process will be another bailout of Greece and a third round of quantitative easing by the Fed. Ben Bernanke isn't talking about QE3 yet, but once the stock market slides by, say, more than 20%, and the US has a negative quarter of GDP growth, it will become a reality very quickly. And that's why I continue to recommend gold in the form of coins or bars or as an ETF like the SPDR gold shares, ticker symbol GLD. I'm Claus Vogt for Money and Markets TV. Thanks for watching.